Welcome, curious minds, to another deep dive. Ever wonder why even really smart investors sometimes stumble? Or how some consistently seem to navigate market chaos, while others just get swept away?
Yeah, it's a perennial question, isn't it?
It really is. Today, we're plunging into the profound world of investing, but maybe not just the cold numbers game you typically think of. We're talking about it more as an art form, something intimately woven with the messy, often surprising threads of human psychology.
Absolutely, that's key.
And our compass for this journey is a pretty remarkable book, Most Important Thing Illuminated by the legendary Howard Marks.
A fantastic resource.
It really is. It's work that takes decades of investment philosophy and just distills it into insights that are both practical and honestly deeply profound. So get ready to have your thinking challenged a bit.
And that's precisely why this book is so pivotal, I think, for anyone seeking a true edge in the markets. It really transcends the typical buy this stock now advice you hear everywhere, doesn't it?
Oh, completely. Yeah.
Yeah. Marx's insights, which he originally shared in his incredibly influential memos to clients, those are already a treasure trove in themselves.
Mm-hmm.
But what makes Illuminated truly special is how it's enriched with annotations from, well, a stellar lineup of seasoned investors. People like Christopher Davis, Joel Greenblatt, Seth Klarman.
Big names.
And Professor Paul Johnson, too. Yeah, really big names. They each bring their unique perspectives, adding these layers of understanding to Marx's hard-earned wisdom, as he calls it.
Right.
So this deep dive today, it's designed as your shortcut, really, to grasping these essential elements for successful investing, helping you cut through all the noise and get straight to the core principles that, truly matter.
Right, I can see that. And as we navigate this wisdom, we're going to encounter this central paradox that Marx himself highlights, right? What exactly is the most important thing?
Right, the title itself poses the question.
Yeah, exactly. And he got into his own surprise, that it wasn't just one singular insight, but 18.
18.
But here's the narrative thread we'll follow today. These aren't just isolated pieces of advice. They really build on each other. They create this holistic framework that challenges conventional wisdom and ultimately leads to profound asymmetry in results.
Mm-hmm. That's the goal.
So we'll start with the fundamental mindset, then see how it reframes our understanding of risk, allows us to maybe capitalize on human psychology, and ultimately helps us navigate what is, let's face it, an inherently uncertain future.
It's like building a wall, as you said in the outline, brick by brick.
Exactly, like building a solid wall, brick by carefully placed brick. Each most important thing is pretty much indispensable to the whole structure. Okay, so let's start at the very foundation. Howard Marks himself.
Okay.
Widely recognized, co-founder of Oaktree Capital Management back in '95. And if you're in the investment world at all, you almost certainly encountered his famous memos to clients.
Oh, they're legendary. Required reading for many.
Totally. And they're not just market updates, are they? They're these deep, almost philosophical explorations. And they form the very core of the most important thing. What's striking is just how timeless their lessons truly are, spanning decades of market cycles.
Indeed. Mark's philosophy, as he puts it, it really comes from going through life with your eyes open, just observing.
Simple but profound.
Yeah, it's about being incredibly observant of events, understanding their outcomes, and then applying those lessons when, similar circumstances arise again. Seth Klarman, one of the annotators, he emphasizes that this constant alertness doesn't just help you identify and avoid risks you've seen before.
Right.
It also helps you prepare for something that has never before occurred. It's about this deep, continuous learning process, not just following a fixed rule book or relying only on past patterns. It's about being mentally present, adaptive.
And a significant part of Marx's own formative experience was navigating the incredibly challenging 1970s.
Oh, yeah. Tough times.
Think about it. Investment jobs were scarce then. So anyone who lived through that decade as an investor had to have been in the industry already.
Sure. Established.
Marx points out this really stark contrast. He says many investors recruited in the 80s or 90s, like before 1999, they literally hadn't seen a market decline greater than 5%.
Wow. 5%? That's nothing in the grand scheme.
Exactly. And Seth Klarman, he calls this one of the most shocking statements in this book. He notes that these investors were essentially lulled to sleep by this prolonged bull market.
Complacent.
Totally complacent, making them incredibly vulnerable when true market volatility inevitably returned with a vengeance. They just hadn't experienced sustained adversity.
That lack of lived experience, it's a huge blind spot, isn't it?
Absolutely.
It really underscores how critical it is to learn from history, even if it's not your own personal history. And Marx, he openly shares his intellectual influences, right? He gives credit to Charlie Ellis's The Loser's Game.
Focus on avoiding mistakes.
Exactly. And John Kenneth Galbraith's A Short History of Financial Euphoria, a masterclass in speculative bubbles.
Classic.
And Nassim Nicholas Taleb's Fooled by Randomness, which really challenges our perception of luck versus skill.
All foundational reads.
Yeah, profound works that challenged conventional wisdom. And Professor Paul Johnson, who teaches value investing at Columbia Business School, he enthusiastically notes that Marx's own book now belongs squarely on that essential reading list.
High praise.
It's a testament to its enduring value and its unique place in investment literature, definitely.
So, okay, if Marx's intellectual journey shaped his foundational understanding, how did he translate that into, like, an actionable philosophy? Because he has this really interesting take on investing itself. He views it, much like economics, as more art than science.
Right. Not a hard science.
Yeah, it's messy, intuitive, constantly adaptive. Not something you can just reduce to a fixed algorithm and hand over to a computer.
Right.
What's the implication of seeing it as an art?
Well, that's a crucial distinction, I think. It means successful investing is never, ever routinized. You can't just plug in numbers and expect perfect results every time.
Right. No magic formula.
Exactly. It demands adaptability, intuition, a willingness to adjust your approach based on ever-changing circumstances. Relying solely on rigid formulas, that's just a recipe for being left behind when the market inevitably pivots. The human element, the art part, that's what allows investors to navigate the unpredictable, to interpret those qualitative factors, and to react to the subtle shifts in sentiment that a purely scientific approach would just miss. It's about judgment and nuance.
That makes perfect sense. So if investing is an art, what does Marx believe defines success in that art? Because it's not just about participation, is it? Like, how does he differentiate true success from just getting lucky in this art of investing, especially when so many seem to just stumble into gains sometimes?
Yeah, you've really hit on the core of his philosophy there. Marx defines success not as simply earning average market returns, right? But quite specifically as doing better than the market and other investors.
Outperforming.
And to achieve that, he says, you need superior insight, not just plain luck. And this brings us to Marx's pivotal concept, the absolute core differentiator for superior performance. Second-level thinking.
Okay, second-level thinking.
This is what separates the wheat from the chaff, really. First-level thinking is, well, it's simplistic, superficial, easily accessible to everyone, and it leads, almost by definition, to average results.
Because everyone's doing it.
Pretty much. Second-level thinking, however, he describes as deep, complex, and convoluted. It's about seeing beyond the obvious, truly understanding what others are missing.
Okay, can you give us a concrete example from the book, but something that really illustrates this? Because it sounds a bit abstract, but I bet it's clear when you see it in action.
Oh, absolutely. Marx provides several fantastic, relatable examples. Okay, so a first-level thinker might say, it's a good company, let's buy the stock. Simple, right? Straightforward.
Yep, makes sense on the surface.
But the second-level thinker takes it several steps further. They say, it's a good company, yes, but everyone thinks it's a great company. And that collective enthusiasm has already pushed its price far beyond its intrinsic value. Therefore, it's probably overpriced already. Maybe we should sell instead, or at least not buy. See the difference.
That's a huge difference in perspective.
Wow.
Okay, and the second example.
Another good one. First-level thinking reacts to current sentiment, right? The outlook calls for low growth, so let's dump all our stocks. It's that immediate gut reaction.
Panic mode.
Kind of. But the second-level thinker considers the context. The outlook stinks, yes, but everyone else is selling in a panic, pushing prices to irrational lows. This isn't a time for fear. It's precisely the time to buy because the bad news is already more than priced in. And my personal favorite, first level, earnings will fall, sell. Second level, earnings will fall less than people expect, right? And that pleasant surprise will lift the stock, buy.
It's about the expectation gap.
Exactly. It's about relative expectation and how the market reacts to surprises, not just the absolute numbers themselves.
So it's not just about knowing what's happening, but understanding how everyone else is reacting to it, and then figuring out the implications of those reactions. Wow, that sounds like a massive mental workload.
It is.
Marx points out that the number of people genuinely capable of this second-level thinking is, like, tiny. compared to those operating at the first level.
It absolutely is a mental marathon. Paul Johnson praises Marx for successfully articulating the critical importance of this distinction, highlighting how difficult it is to actually do.
Right. Easy to say, hard to do.
Very true. And Joel Greenblatt adds that this is precisely where individual investors often stumble. They fall into first-level thinking by just reading headlines or watching financial news.
Reacting to the noise.
Exactly, reacting to the surface, not the underlying complexity. And so they get average results, maybe worse. Christopher Davis offers a fantastic piece of advice here. When evaluating investments, don't just ask what you should do to succeed.
Okay.
Instead, he says, invert the problem. Ask yourself why others might fail.
Interesting approach. Like, what are their blind spots?
Precisely. Is it their flawed time horizons? Are their incentive systems maybe inappropriate? This unique perspective, having ideas that are different and to process those ideas differently, that's the only route to superior results. Remember, as Marx states, all investors can't beat the market since collectively they are the market.
Right. Zero-sum game in that sense.
Kind of. Joel Greenblatt summarizes it succinctly. Agreeing with the broad consensus is not generally where above-average profits are found. If you're going to outperform, you have to be different and better. And that starts with your thinking process, that second-level thinking.
Okay, we've talked about Marx's belief that superior insight is key to beating the market. But what about the widely accepted academic view on whether the market can even be beaten? This brings us to the efficient market hypothesis, right? The EMH from the Chicago School of Finance. Can you give us the basic premise there?
Certainly. Its core tenets are quite compelling, at least in theory. EMH suggests that, look, there are many intelligent market participants out there.
Really?
All with roughly equal access to information. They're objective, highly motivated, hardworking. And because of their collective efforts, all available information is immediately reflected in asset prices. Everything becomes fairly priced, pretty much instantly. Therefore, no one can consistently profit from mispricings, and riskier assets simply offer higher expected returns as compensation for that risk. In short, there's no free lunch in the market. All known information is already priced in.
So if prices truly reflect the consensus view, and holding that consensus view only leads to average returns, well, then beating the market logically demands an idiosyncratic view, right? A non-consensus view. That's the theory.
Correct.
But practically, how does Marx connect this maybe somewhat abstract EMH idea with the demanding work of second-level thinking? What's the real-world bridge he builds here for us investors?
Yeah, and that's Marx's crucial contribution, as Paul Johnson points out. The EMH basically states that prices already incorporate all the common knowledge and expectations.
Okay.
Therefore, if you hold a consensus view, you're essentially signing up for average returns. Makes sense, right?
Yeah, logically.
So, to achieve superior returns, you must deviate from the consensus. And crucially, that deviation isn't just a guess. It has to be based on superior insight, that second-level thinking we just talked about.
So it links back directly.
It's the practical application of the EMH's implications. If you want to get different results, you have to think differently and, frankly, better than the consensus.
So the most important practical upshot of EMH, at least according to its staunchest proponents, is this conclusion that you can't beat the market.
Right, the strong form, yeah.
And this is often supported by numerous studies showing that very few mutual funds consistently outperform their benchmarks, especially after fees.
True. The data often backs that up.
Even the celebrated five-star funds, they're rated relative to each other, right? They don't necessarily beat an objective market index consistently.
That's a good point. Relative versus absolute.
And as for the Warren Buffetts of the world, Marx argues they're exceptional precisely because consistent outperformers are so rare. They're the exceptions that prove the rule, in a way. And this EMH conclusion, it famously led to the widespread development of passive index funds. The idea being, just accept market returns at minimal cost. Exactly.
If you can't beat it, why try and pay high fees for the privilege of likely underperforming anyway? Just buy the market index.
But the crucial question Marx poses is the market truly unbeatable? He argues the answer isn't so simple. While the idea of thousands of rational, numerate people efficiently pricing assets, well, it sounds logical in principle.
It does.
But human behavior, he argues, throws a huge wrench into that perfect theoretical machine.
A very human wrench, yes.
And Marx's critique zeroes in on a key EMH assumption, this idea of objectivity.
Right, that we're all rational calculators.
Exactly. He states unequivocally that human beings are not clinical computing machines. Instead, we're driven by powerful emotions, greed, fear, envy, that make true objectivity basically impossible. So how does this human element open the door for significant mistakes in pricing, as he suggests?
Well, think about it. If investors were objective, emotionless robots, then yes, prices would probably instantly reflect true value. But Marx says that's just not reality.
Clearly not.
Our emotions lead us to overpay in times of euphoria and panic sell during periods of fear. This opens the door for significant recurring mispricings. And Seth Klarman adds another layer here. He observes that investors often operate in silos.
Silos, like specialists.
Yeah, exactly. An equity manager focusing only on equities, a bond manager only on bonds, maybe a specialist just in tech stocks. This narrow focus can lead to mispricings that fall outside these rigid boundaries, creating opportunities for those who look more broadly across asset classes and don't confine their analysis to these sort of artificial categories.
Okay, so Marx offers powerful counterarguments to the pure EMH. Market prices are often wrong. Risk-adjusted returns can be out of line, and yes, some investors can consistently outperform. It's not a perfect, unassailable fortress, which is, I guess, good news for active investors.
Precisely. He reinforces that inefficiency is a necessary condition for superior investing. It means prices aren't always fair, and mistakes are being made by others, but, and this is a critical but, inefficiency alone isn't sufficient.
Okay. Just because the market's messy doesn't mean I'll win.
Exactly. You still need to be more insightful than others to consistently take advantage of those mispricings. It requires that second-level thinking we keep coming back to. Joel Greenblatt emphasizes that investments that are out of favor, the unpopular stuff, often create these very opportunities precisely because most professionals avoid them. They're looking for performance right now, to keep their clients happy or keep their jobs, rather than focusing purely on long-term value.
The career risk factor again.
It plays a big role.
And this section wouldn't be complete without Mark's famous anecdote about the finance professor, right? He walks past a $10 bill lying on the ground.
Yes.
When his student points it out, the professor just dismisses it. No, it can't be a $10 bill. If it were, someone would have picked it up by now.
Classic EMH logic applied literally.
And the student, of course, picks it up and enjoys a beer. It's just a brilliant illustration of how rigid theory, when taken to an extreme, can completely override common sense and lead you to miss opportunities that are literally lying at your feet, blinding you to plain sight.
Theory dominating common sense. Yeah.
That's a perfect segue into the power of value investing. This concept harks back to what Marx calls the oldest rule in investing. Buy low, sell high. Pretty simple, right?
Yeah.
But what defines low or high in a meaningful way beyond just looking at price charts?
Yeah. Buy low, sell high sounds easy, but it's the hardest part. Marx explains that this goes far beyond simply studying past price movements, which is what technical analysis does, or, chasing trends, which is momentum investing.
Right. Different approaches.
He considers merely following trends like day traders often do, not a cerebral approach. He offers a great analogy. It's like trying to guess whether the next person around the corner will be male or female. It's basically a 50-50 chance, not something you can consistently gain an edge on.
Not much skill involved there.
Not really, and he highlights the flaw of very short-term trading. A day trader might celebrate making, say, $3 on a stock, but that stock might have appreciated by $30 overall in a longer trend. They're missing the bigger picture entirely by focusing on the trivial, the tiny fluctuations, rather than the fundamental value changes.
So Marx clearly distinguishes value investing, which is about rigorously figuring out a security's current intrinsic value and then buying it when its price is significantly below that value, from growth investing, which focuses more on finding securities whose value is expected to increase rapidly in the future.
Two different philosophies.
And Marx explicitly states his preference. Value is my approach. For him, consistency trumps drama. He's not looking for the next big thing necessarily, but for reliable value.
That's right. And Joel Greenblatt, himself a celebrated value investor, points out that Warren Buffett says the best investment course would teach just two things: how to value an investment and how to think about market price movements.
The two pillars.
Pretty much. Marx stresses that without an accurate estimate of value, any hope for success is just that, hope. You're essentially gambling. Overpaying for an asset, no matter how good it seems, requires either incredible luck or finding a greater fool later on to bail you out at an even higher price.
Right. the greater fool theory.
And Seth Klarman adds that the bigger the discount to intrinsic value, the bigger your margin of safety, which is crucial, right? It's about protecting your capital first and foremost.
Yet, even with that clear logic, there's this huge psychological hurdle. Marx observes a common fear. If you liked it at 60, you should like it more at 50, and much more at 40 and 30. Logically, yes.
Makes sense on paper.
But the reality is, no one's comfortable with losses. It feels terrible to see something you bought go down.
It really does. Psychologically painful.
And this discomfort often leads investors to sell at the very bottom, precisely when they should be buying more, rationally speaking. This fear of looking wrong is, as Marx highlights, a major, major pitfall. It's so easy to be paralyzed by it, or worse, prompted into the wrong action.
And that's Marx's core insight, and it's so powerful. Investment success comes not from buying good things, but crucially from buying things well. Price is always the starting point.
Price.
He makes a profound statement here, really worth repeating. No asset is so good that it can't become a bad investment if bought at too high a price. And there are few assets so bad that they can't be a good investment when bought cheap enough.
That completely flips conventional wisdom on its head, doesn't it?
Yeah.
It's not just about the quality of the company, but the bargain you get in the price.
Exactly. It's the relationship between quality and price. Now, Christopher Davis adds a critical caveat here, which is important. Beware of obsolescence, turning a cheap stock into a value trap.
Yeah. Cheap for a reason.
Right. A cheap price on a dying business isn't a bargain. It's just cheap and likely to get cheaper. You still need to assess the underlying business quality. And Joel Greenblatt reinforces the main point. If price has not yet been considered, you can't know if it is a good investment. It's just that fundamental.
This philosophy is so ingrained at Oaktree that Marx shares their motto, well bought is half sold.
Love that motto.
It means they don't obsess over when or to whom they'll eventually sell. If you buy something cheap enough, he says, the selling questions kind of will answer themselves. It's a testament to the power of making a good initial purchase decision based on price.
He further explains that short-term price fluctuations, those day-to-day wiggles, they're often driven by psychology and what he calls technicals, non-fundamental factors. Things like forced selling due to margin calls during market crashes, or maybe huge mutual fund inflows requiring managers to buy regardless of price.
Stuff that's not about the company's actual value.
Exactly. And Marx describes these moments as prime opportunities. Believe me, he says, there's nothing better than buying from someone who has to sell regardless of price during a crash.
Being on the other side of that forced selling.
Precisely. However, being the forced seller, that's the worst, requiring significant long-term capital and strong psychological resources to avoid getting into that devastating position in the first place. It's really about being prepared, both financially and emotionally, to be a buyer when others must sell, regardless of their logic or the asset's intrinsic value at that moment.
Okay, now let's tackle one of the most critical and, I think, often misunderstood aspects of investing, risk. Marx has a strong disagreement with the common academic definition of risk as mere volatility or variability. For him, those terms just don't convey the necessary sense of peril. What's he getting at there?
Yeah, he really pushes back on that. And Paul Johnson echoes this, suggesting that for thoughtful investors, the risk of permanent capital loss is the only risk to worry about. Volatility might make you uncomfortable, sure, might feel bad.
Stomach churning sometimes?
Right, but it doesn't necessarily mean you've lost money permanently. Marx expands on this by identifying several other critical forms of risk. There's falling short of one's goal, which is a deeply personal, subjective risk, right? Your specific needs. And the market doesn't compensate you for that kind of personal risk, unlike other risks.
Interesting distinction.
Then there's underperformance, the dreaded benchmark risk for professional managers, where sticking to a disciplined approach like value investing when growth is hot can actually lead to periods of lagging the market.
Right, looking dumb temporarily.
Exactly. And Joel Greenblatt highlights a shocking statistic here. 79% of top quartile managers in the 2000s spent at least 3 years in the bottom quartile.
Wow, nearly 80%.
Yeah, simply because most investors chase the hot fund and don't stick around through the inevitable style cycles. That puts huge pressure on managers to avoid underperforming, even for short periods.
That's a powerful statistic, really highlights the pressure. He also points to career risk, where managers might prioritize their job security over what's truly optimal for client returns. This is a subtle but profound trap, isn't it?
Very subtle, very real.
Because how do you reconcile a manager's natural desire for job security with a client's need for maybe unconventional, potentially uncomfortable, but ultimately superior long-term returns.
It's a huge conflict of interest, potentially.
It often means a manager avoids strategies that could lead to short-term underperformance, even if they're the right thing for the long run, just to avoid looking bad or losing assets. And then there's the unconventionality risk itself, the sheer discomfort of being different from the herd.
Which is necessary for outperformance, as we said.
Exactly. Yet this very discomfort often creates the opportunities. And finally, illiquidity, the risk of not being able to convert an investment to cash at a reasonable price when you absolutely need to could. A risk that often rears its ugly head when panic sets in and cash is king.
Yeah, liquidity disappears right when you need it most, typically. Now, when we talk about how investors expect higher prospective returns for taking on riskier investments, Marx illustrates this with the capital market line.
Okay.
Think of it as a chain of required returns. You start with the riskless rate, like T-bills, right? And then you add premiums for things like time horizon, credit risk, illiquidity risk, complexity, and so on.
Building blocks of expected return.
Exactly. And he noted back in 2004, for example, that a low riskless rate, say 1% compared to a historical average of maybe 4%, meant that the bar for each successively riskier investment has been set lower. This led to what he called a low and flat capital market line.
Meaning you weren't getting paid much extra for taking on more risk.
Precisely. This richening process, where assets become more expensive across the board and yields get compressed, it reduces prospective returns and, ironically, creates a high-risk environment because you're encouraged to take on more and more risk just to achieve a decent potential return. It's a subtle but crucial point about how overall market conditions themselves can signal danger.
You know, what I found particularly fascinating in this section, and honestly a bit unsettling, is a concept Marx calls the perversity of risk. Can you unpack that for us? Because it seems like it's something incredibly important, yet maybe really hard to pin down in real time, especially when emotions are running high and the market feels either way too safe or way too scary.
Oh, this paradox is profound and, yeah, quite unsettling. It basically means the market's perceived safety is often its greatest danger.
How so?
Well, when everyone feels risk is high, right, when there's fear everywhere, their caution selling assets, demanding higher returns for risk, actually makes the market inherently safer because prices get pushed down and demands for compensation are high.
Okay, fear leads to safety. Paradoxically.
Exactly. But the flip side is, when risk feels low, when everyone's complacent and optimistic, that collective complacency pushes prices to dangerous highs, effectively creating the very risk they're ignoring.
So the lack of fear creates the danger.
That's the perverse part. The truly insightful takeaway here is, counterintuitive as it sounds, the market is often safest when it feels riskiest, and most dangerous when it feels safest. This is why a disciplined investor must constantly question the consensus feeling. Christopher Davis offers that great analogy of SUV drivers feeling safer and thus driving more recklessly. The feeling of safety increases the actual risk, while the awareness of risk tends to reduce it.
And Marx recounts that global risk reduction fairy tale from 2005, 2007. This was the widely believed narrative that central banks had everything under control, globalization was smoothing things out, securitization, where complex assets like mortgages are carved into different risk slices or tranches, and all that rampant leverage had somehow made the world less risky.
Yeah, the great moderation narrative.
Right. Marx calls this belief one of the most dangerous sources of risk. It sounds incredibly insidious because it felt so convincing at the time.
It is insidious. Joel Greenblatt notes the importance of understanding this for diversification. Marx argues forcefully that risk cannot be eliminated, it just gets transferred and spread, often in ways people don't understand. Developments that make the world look less risky are often illusory, he says, and in fact, they tend to make the world more risky because they encourage risky behavior based on false confidence.
Like the mortgage example.
Exactly. This was, as Marx points out, a core lesson hammered home by the 2007 financial crisis. Ultimately, Marx's core belief boils down to this. Investment risk comes primarily from too high prices, and too high prices often come from excessive optimism and inadequate skepticism and risk aversion. The herd often mistakenly believes that the quality of the asset alone determines risk, not the price paid for it. That's a fatal mistake.
And Christopher Davis strongly concurs with that, noting the dangers of equating a high-quality asset with a high-quality investment. He warns against hindsight bias and the halo effect, where we assume a company's past great performance guarantees future success.
Doesn't work that way.
No. He reminds us that many, many formerly high-quality companies disappear or fall from grace, proving that even great companies can be terrible investments if you buy them at the wrong price. The quality of the asset simply doesn't protect you from a bad purchase price.
Price matters most.
Okay, if we're going to avoid those pitfalls, those high prices born of optimism, we absolutely have to talk about human psychology and emotions. Marx explicitly states that the biggest investing errors come not from factors that are informational or analytical, but from those that are psychological. This is the real battleground for investors, isn't it?
It absolutely is. The internal battle. He delineates several key psychological forces that consistently lead investors into errors. First, there's greed and optimism. This powerful combination drives investors to pursue high returns without expecting high risk, to pay elevated prices for whatever's in vogue, and to hold on to things long after they've become clearly overpriced.
Hope springs eternal.
Right. And in hindsight, Marx notes, it always becomes clear that expectations were unrealistic and risks were ignored. Then there's the flip side, fear or outright panic, the counterpart to greed, which paralyzes constructive action when it's needed most, leading to selling at the absolute bottom out of sheer terror.
Buying high, selling low, the classic mistake driven by emotion. And a fascinating one he calls willing suspension of disbelief. What's that?
This is the tendency to just dismiss logic, history, and what he calls time-honored norms in order to accept unlikely propositions, usually because they promise quick riches.
This time it's different.
Exactly. Marx quotes the ancient Greek orator Demosthenes. Nothing is easier than self-deceit, for what each man wishes that he also believes to be true. This, Marx argues, is invariably at the core of every speculative bubble when people conveniently ignore all the warning signs because they want to believe.
Powerful quote.
Adding to this is the extreme brevity of financial memory, a great phrase from John Kenneth Galbraith. Investors constantly forget past patterns, hailing old ideas as brilliantly innovative when they inevitably recur, as if no one has ever thought of them before. We just don't learn from history well. Joel Greenblatt candidly confesses that his own mistakes are often the same ones, just slightly disguised.
We repeat our mistakes.
We do. Then there's the silver bullet illusion, this relentless search for an infallible investment strategy or a free lunch, meaning high returns without any risk. Marx asserts bluntly, the silver bullet doesn't exist. This uncritical belief, this search for an easy answer, leads to what he calls capital punishment, meaning significant painful losses. Warren Buffett famously summarized this effect. Rising prices are a narcotic that affects the reasoning power up and down the line, making everyone believe in the impossible dream.
Another powerful force is conformity to the herd. Marx references Solomon Asch's famous experiments from psychology.
The line length experiments, yeah.
Right, which demonstrate how people will literally ignore their own senses and judgment just to side with a group, even when the group is obviously demonstrably wrong. John Cassidy notes that during bubbles, eventually, it appears the really crazy people are those not in the market. The pressure to conform becomes immense. You feel like an idiot for sitting out.
Social proof is incredibly strong. And finally, Marx points to envy. He calls it a potent force, sometimes even stronger than greed, especially when you're comparing yourself to others' perceived successes, your neighbor getting rich on some stock you didn't buy. This fuels self-doubt and often makes investors do the exact wrong thing at the wrong time, chasing whatever everyone else seems to be getting rich on.
FOMO, fear of missing out.
Exactly. FOMO driven by envy.
The tech bubble of the late 1990s serves as just a textbook example of all these psychological pitfalls in action, right?
Yeah.
Logical-sounding rationales, like the undeniable excellence of many tech companies or their inclusion in major indices, seem to justify wild, insane appreciation. And it drew in investors who, as Marx vividly describes, didn't even know what the companies did. It was just this collective suspension of disbelief, fueled by greed, conformity, and envy, that drove prices to absolutely absurd levels.
A perfect storm of psychological errors. And the irony is, as Howard Marks himself points out in one of the annotations, a lot of brilliant, disciplined value investors looked dumb in the months and years before the bubble burst.
Yeah, they underperformed massively for a while.
Massively. They were often labeled pessimists, grumps, or old fogies, until they turned out to be among the few who protected against losses when the bubble inevitably popped. It just highlights how incredibly hard it is to stick to your guns, to your discipline, when everyone else seems to be getting rich easily and you're the one left out of the party.
It takes real conviction.
That's why Marx stresses that combating these negative influences requires several things. a strong sense of intrinsic value as your anchor, a deep understanding of past market cycles, an awareness of psychology, both yours and others, remembering that mantra, if it sounds too good to be true, it probably is, and crucially, having the willingness to look wrong, maybe for a long time while the market becomes even more misvalued. It's a profound act of self-control and intellectual fortitude to stand against that powerful tide.
So if, as Marx says, at the extremes, which are created by what most people believe most people are wrong, then it logically follows that the key to investment success has to lie in doing the opposite, in diverging from the crowd. This is the essence of contrarianism, but it's clearly not as simple as just doing the opposite of whatever seems popular, is it?
No, it's anything but simple. Contrarian behavior, as Marx explains it, means you buy when they hate 'em and sell when they love 'em. Basic idea. While those once-in-a-lifetime market extremes are rare, acting decisively during them should be a core component of your long-term strategy. Seth Klarman notes that the teachings of Graham and Dodd provide the psychological fortitude needed for this. They allow you to maintain a cheerful disposition even when owning a stock that's declining, because you remember you own a fractional interest in a real business that's trading at a discount to its actual worth.
Focusing on the business, not the stock price quote.
Exactly. But, and this is key, contrarianism isn't as simple as just betting against the crowd blindly. You must know why the crowd is wrong, and that understanding has to be based on reason and analysis. Otherwise, you're just gambling in reverse, betting against momentum for no good reason.
Right. Needs to be grounded.
And it's also, as Yale's legendary endowment manager David Swenson points out, lonely and uncomfortable. Standing apart feels bad. Plus, the very coalescing of popular opinion behind an investment tends to eliminate its profit potential. By the time everyone agrees, the opportunity is usually gone. It's the discomfort, the loneliness, that often signals the presence of opportunity.
Marx reiterates his core paradox here. What's clear to the broad consensus of investors is almost always wrong. Joel Greenblatt calls this observation extremely simple and extremely insightful. It's a fundamental truth that's often overlooked precisely because it goes against our innate desire for social validation and comfort.
It really does, and Marx shares an epiphany he had during the depths of the 2008 credit crisis. Skepticism isn't just about saying, no, that's too good to be true at market tops when everyone is euphoric and prices are high.
Okay.
It also requires saying, no, that's too bad to be true at market bottoms when everyone is in despair and selling off everything indiscriminately, convinced the world is ending.
Skepticism works both ways, against excessive optimism and excessive pessimism.
Exactly. And that profound realization led to some incredible opportunities, as he described how buying deeply depressed debt in late 2008 yielded returns of 50-100% or more in the following year, simply because almost no one was saying, no, things can't be that bad. Buying, then, was the ultimate act of contrarianism, stepping in with analysis and conviction when the world was convinced everything was collapsing permanently.
Wow, takes guts.
Which underlines a key point he makes. A hugely profitable investment that doesn't begin with discomfort is usually an oxymoron. If it feels comfortable and easy, it's likely already too late. The bargain aspect is gone. It's the contrarian's difficult job, he says, to catch falling knives, hopefully with care and skill, using a strong sense of intrinsic value as their guide and their protection. If you wait until the uncertainty is resolved and the dust has settled, the bargains are already gone because the fear that created them has dissipated.
Okay, so where exactly are these elusive bargains found then? Marx explains that the goal isn't just to find good assets, we've heard that before, but to find good buys. As he famously puts it, maybe the most quoted line, it's not what you buy, it's what you pay for it.
The mantra. Christopher Davis agrees, though he adds that crucial caveat again about applying risk and selection criteria, meaning you can't just buy anything cheap. It still has to meet your fundamental standards for business quality, management, etc.
Right. Avoid the value traps.
Exactly. Marx describes how bargains often arise when a former market darling, something everyone loved, becomes an orphan asset, ignored, scorned, subject of unflattering media attention, and usually falling precipitously in price. Seth Klarman notes, generally, the greater the stigma or revulsion, the better the bargain.
Counterintuitive again. The worse it looks, the better the potential price.
Often, yes, it's counterintuitive. But that stigma, that hatred, drives prices down far below intrinsic value, creating opportunity for the discerning, unemotional buyer. These are the assets that don't make headlines in a good way, the ones that fund managers are maybe afraid to own because of career risk if they keep falling, but they're often where the real asymmetric money is made over the long term.
He provides a fantastic shopping list for these potentially underpriced assets. They're typically little known or poorly understood, fundamentally questionable, at least on the surface, controversial, unseemly, or even scary.
Not comfortable stuff.
No, they're often deemed inappropriate for respectable portfolios. They're unappreciated, unpopular, unloved, trailing poor recent returns, and have recently been the subject of disinvestment, not accumulation. This is where the diamonds in the rough are often found. Can you give us some specific examples of these ugly ducklings that Marx and Oaktree turned into swans?
Yeah, Marx gives great personal examples from his own career. Things like convertible securities, which were an unappreciated market backwater for a long time because they combined features of bonds and stocks and weren't easily categorized by traditional analysts. High yield or junk bonds, initially dismissed as totally taboo, lacking the characteristics of a desirable investment when they first emerged in the late 70s, early 80s, but he saw their underlying value and the compensation for risk was often excessive.
Right. Junk was a scary word.
Very scary. And distressed debt, which is debt from bankrupt or near bankrupt companies, which many investors found unseemly, too complex, or just too depressing. Each of these asset classes, initially dismissed by the consensus and deemed too risky or too niche, turned into a great place to be for decades, precisely because they were unloved and, crucially, mispriced due to that lack of love.
Building on that idea of finding bargains where others aren't looking, Marx introduces the concept of patient opportunism. This means recognizing that, frankly, there aren't always great things to do. Sometimes maximizing your contribution as an investor means being discerning and relatively inactive, which is incredibly difficult for many, especially professionals who feel pressure to always be doing something.
Yeah, the bias for action is strong. Paul Johnson highlights that humans are simply not naturally wired to be patient, and we often confuse action for adding value. We feel like we have to be trading, making moves.
Feels productive, even if it isn't.
Right. Warren Buffett famously captures this need for patience with his Ted Williams baseball analogy. Williams was famous for only swinging at pitches in his sweet spot. Investors, Buffett says, have the incredible advantage over baseball players of not striking out looking. You never have to swing.
You can wait indefinitely.
You can wait indefinitely, allowing you to wait for the pitch you like until it's right in your sweet spot, maybe when the fielders are asleep. You can simply wait for truly exceptional opportunities without penalty. You don't have to participate in every market rally or every perceived opportunity.
Of course, there's that penalty for missing winners.
Yeah.
The opportunity costs, right? And professional investors face immense pressure from clients if their returns lag, even temporarily. We saw that before the credit crisis, people reaching for yield in low-return environments simply to try and perpetuate historical returns. That inevitably leads to mistakes. That pressure can be a silent killer of good judgment.
It really can. Marx emphasizes a crucial truth here. You simply cannot create investment opportunities when they're not there. Trying to force it, trying to perpetuate high returns when asset prices are already high and prospective returns are low, only leads to low prospective returns and high risks. Joel Greenblatt notes the flip side, too. High valuations can often go higher and last for longer than expected, continually frustrating disciplined and patient value investors. So patience, even in the face of temporary underperformance or watching others seemingly make easy money, is absolutely key to avoiding bad investments forced by impatience.
And Marx argues that the absolute best buying opportunities, the truly generational ones, arise when asset holders are forced to sell. Not because they want to, but because they have to, due to things like client withdrawals, hitting regulatory or guideline violations, or facing margin calls during periods of extreme market chaos. This means you need to be financially and psychologically prepared before those moments hit.
Ready to act when others can't. And in those moments, the phrase, regardless of price, becomes, as Marx puts it, the most beautiful words in the world to a prepared buyer. He recounts the 2008 crisis, where things like senior bank loans, which had been levered to the hilt, plummeted in price. This triggered what are known as BWIC auctions, that stands for Bid Wanted in Competition.
Okay.
Essentially, rapid-fire sales where desperate sellers are trying to offload assets quickly and buyers are competing, often driving prices incredibly low. These were critical moments for distressed debt investors like Oaktree, offering massive appreciation potential in 2009 as things stabilized. Paul Johnson calls Marx's advice to be financially insulated and psychologically positioned to buy in those moments excellent advice. It requires a strong balance sheet and real emotional fortitude to step into that kind of chaos and buy when everyone else is screaming, sell.
Finally, let's turn to Marx's contention that the future is unknowable, at least in macro terms. Things like interest rates, GDP growth, election outcomes. He argues we should focus our efforts on the knowable, things like specific industries, companies, securities, where a genuine knowledge advantage is actually possible through hard work. But this is tough, isn't it? We all crave certainty. We all want to know what the market is going to do tomorrow or next year.
It's human nature to want to know. But Paul Johnson emphatically states, be very careful with your own forecasts and even more careful with those of others. Marx's own informal research found that most economic and market forecasts are generally inaccurate. They're largely based on just extrapolating the recent past, not on true foresight.
Trend following, basically.
Pretty much. They consistently miss major turning points and big changes. And even when someone is right about a big call, it's rarely the same person consistently. Predicting the macro future reliably is just incredibly difficult, maybe impossible. The world is simply too complex.
This presents a fascinating investing dilemma, then. Our results are determined by the future, but we can't truly know it. And Marx points out that correct forecasts of normal times are of little value anyway, because markets usually price those normal expectations in already.
Right, no edge there.
However, accurate forecasts during unusual times, during crises or major shifts, would be invaluable. But those are precisely the times when forecasts are least likely to be correct, because things are chaotic and unpredictable. It's a real catch-22. Paul Johnson praises Marx's list of 9 bullets outlining forecasting shortcomings as the best discussion I have ever read on the topic.
It's a great section. Marx distinguishes between 2 schools of thought here. The I know school investors who are confident they know the macro future, who are eager to opine on interest rates, GDP, commodity prices, you name it.
You hear them on TV all the time.
All the time. And then there's the I don't know school, which is much more guarded. They believe you don't have to know the macro future to invest well. The I don't know school accepts that outcomes have a large element of randomness, and that true skill is judged over many, many trials, not just one lucky hit or one bad outcome. Joel Greenblatt cites a striking example where a top-performing fund over a decade still saw its average investor lose money.
How is that possible?
Because they chased returns. They piled in after the great performance and often bailed out after periods of poor performance. Their timing, driven by trying to predict the fund's future, was terrible. It shows that good fund performance doesn't automatically mean good investor returns if your own timing is off because you think you can predict the future.
Wow. And Nassim Nicholas Taleb's idea of alternative histories, thinking about the many things that could have happened, not just what actually did happen, is really central to this, school, isn't it?
Absolutely. It powerfully reveals that good decisions fail to work and bad decisions succeed all the time, simply due to the role of luck or unforeseen events. Marx's entire philosophy is aligned with this uncertain world. It emphasizes defensive investing, acting contrary to the herd when probability seems skewed, and viewing results both good and bad with suspicion until they're proven over many trials. It's about humility in the face of uncertainty.
This leads us naturally to the concept of defensive investing and avoiding those big pitfalls. Joel Greenblatt has that great old saying, there are old investors and there are bold investors, but there are no old bold investors. It perfectly sets the stage for this choice between playing offense and playing defense.
Yeah, it's a classic. And Charlie Ellis's concept of the loser's game applied to investing clarifies this further. In games like amateur tennis, points are usually lost on errors, not won on brilliant shots. You simply try not to make mistakes, and your opponent will eventually make one.
Let the opponent beat themselves.
Right. Investing, similarly, is full of bad bounces and unanticipated developments. Marx likens it more to soccer, maybe, than American football. In soccer, the same players generally play both offense and defense throughout the game. It requires a consistent, all-around approach, rather than having specialized offensive and defensive squads that only focus on one thing. It's about being balanced and, crucially, avoiding those critical errors that take you out of the game.
So offense is about aggressive tactics, taking elevated risk, hoping for above-average gains. But defense, as Marx defines it, is about putting the main emphasis on not doing the wrong thing, preventing the big loss.
Exactly. At Oaktree, their motto reflects this. If we avoid the losers, the winners will take care of themselves. They aim for a good batting average, not home runs. They want consistent singles and doubles, not swinging for the fences every time and striking out often, which can be fatal in investing.
That highlights a profound paradox, doesn't it? Many investment managers' careers end because they strike out too often, not because they don't have enough winners, but because they have too many losers, too many big mistakes.
It's so true. This often comes from betting too much on one idea. incurring excessive trading costs or positioning portfolios only for favorable scenarios instead of ensuring survival if things go wrong. Marx notes the fundamental trade-off, because ensuring the ability to survive under adverse circumstances is incompatible with maximizing returns in the good times. Investors must choose between the two.
You can't have both max safety and max return simultaneously.
No. Marx emphatically chooses to emphasize the former survival, prioritizing staying in the game over hitting it out of the park every single time.
A critical element in this defensive approach is what Warren Buffett calls the margin of safety, or margin for error. Joel Greenblatt identifies this, along with the concept of Mr. Market, as Benjamin Graham's greatest contributions to the field of investing. How does this margin of safety concept truly protect an investor in practice?
Well, you can think of it like a prudent lender making a loan. They structure the loan so it will be repaid even if conditions deteriorate. For example, even if the borrower loses their job because there are sufficient savings, other assets, or maybe alternative income sources, there's a buffer.
Cushion for bad luck.
Exactly. The prudent lender, by insisting on this margin for error, avoids most losses, but they might forego some slightly riskier opportunities that go to less cautious lenders who don't demand that cushion. Remember Citigroup CEO Charles Prince's infamous quote just before the crisis? "As long as the music is playing, you've got to get up and dance."
Yeah, captured the pre-crisis mood perfectly.
It perfectly illustrates the pressure to forego prudence, to ignore the need for safety when everyone else seems to be doing well. But Marx stresses that avoiding losses is ultimately more dependable than striving for great successes, because big losses can be crippling and take you out of the game entirely. If you minimize the chance of loss in an investment, he says, most of the other alternatives are good. Protect the downside, and the upside tends to take care of itself over time.
That makes perfect sense. Buffett's wisdom resonates here again. An investor needs to do very few things right, as long as he avoids big mistakes. These big pitfalls, Marx argues, often stem from a failure of imagination. Just not being able to conceive the full range of possible negative outcomes or the potential consequences of extremes. And of course, those psychological and emotional errors we talked about.
And the 2008 financial crisis is just a prime example of these pitfalls in action. Those complex mortgage derivatives, Marx notes, were designed and sold based on the core assumption there couldn't be a nationwide decline in home prices, simply because it hadn't happened in the modern era.
Famous last words.
Right. This very assumption, he points out, has the potential to make it happen, precisely because it encourages incredibly risky behavior over lending, over borrowing, because everyone believes the ultimate downside scenario is simply not possible. It's a chilling illustration of what happens when theory, based on limited history, disregards the potential for reality to change.
It's also incredibly difficult, or at least costly, to try and insure against these improbable disasters, isn't it? Because it detracts from returns in normal times. The crisis revealed this widespread failure to understand asset correlation. How problems in one area, like subprime mortgages, could spread like wildfire to seemingly unrelated areas like commercial paper, money market funds, and eventually bring down major financial institutions. Few people foresaw that domino effect, how tightly intertwined the whole system actually was.
Very few. Marx succinctly recaps some key lessons from that crisis. First, too much capital availability leads to bad investments. When money is too easy to get, it inevitably flows into less deserving places, funding weak projects or inflating asset bubbles. Second, widespread disregard for risk creates great risk. When no one seems worried, that's when you should be most worried. Christopher Davis suggests a practical tip here. Think in terms of earnings yield, earning price, rather than just PE ratios, as it allows for better comparison across different asset classes and interest rates. It's a more direct measure of potential return relative to price.
Good tip.
Third lesson. Psychological and technical factors can swamp fundamentals in the short run. Fear, greed, forced selling these can dominate price action temporarily. Christopher Davis cheekily warns, beware of geeks with models. Meaning don't put blind faith in complex financial models that don't adequately account for human irrationality or extreme tail events. Fourth, leverage magnifies outcomes but doesn't add value. Paul Johnson emphasizes how many investors fail to appreciate this basic truth. Leverage just makes the good times better and the bad times much, much worse. It doesn't improve the underlying investment quality. And finally, excess is correct. Prices that are priced for perfection are inherently set up for capital destruction when that inevitable perfection doesn't materialize.
So while almost no one knew exactly what the consequences would be heading into 2008, Marx asserts that it was possible to have a sense that we were riding for a fall. It wasn't about having perfect foresight of the exact timing or mechanism, but more a general unease, a feeling based on observation that things were getting too frothy, too optimistic, too risky.
And crucially, investors could have prepared, even without knowing the future exactly. Marx lists concrete actions they could have taken, simply noting others' carefree and risky behavior, preparing psychologically for potentially tough times ahead, strategically selling the riskiest assets in their portfolio, reducing their own leverage, raising cash reserves, and generally tilting their portfolios defensively. This would have allowed them to lose less than others when the storm hit, maintain their equanimity amidst the chaos, and crucially, be more able to profit from the carnage by buying at the lows when everyone else was panicking and selling. Joel Greenblatt advises, "Investor, know thyself. How much pain can you really take on the downside?" It's about knowing your own psychological limits and positioning your portfolio accordingly before the crisis hits. As Marx noted way back in 2004, the likely mistake investors were making then was buying too much, buying too aggressively, taking too much risk. He urged caution precisely when others were charging full speed ahead, and that contrarian caution was his edge.
Okay, so after this really extensive deep dive into Howard Marx's philosophy, let's try to pull it all together. He truly believes, and argues compellingly, that the best foundation for a successful investment or a successful investment career is value. It all starts there, with understanding value and price.
Absolutely. So to recap the critical elements for you, the listener. First, superior insight. You must strive to learn, see, or analyze things better than the average investor. It's all about that second-level thinking.
Got it. Deeper thinking.
Second, a firm sense of value. This acts as your anchor, providing the discipline to buy low and sell high, even when market prices diverge wildly from your estimate of intrinsic value. Remember, buying below value is the most dependable route to profit.
Anchor in the storm.
Third, coping with psychology and technicals. You have to recognize that these powerful forces can dominate fundamentals in the short run. They create both the opportunities for big profits and the potential for big mistakes. You must be ready to capitalize on the opportunities created by others' emotions while avoiding succumbing to your own.
Master your emotions, understand others.
Fourth, awareness of cycles and the pendulum. Recognizing that trends inevitably reverse, that markets swing between euphoria and despair, and that being part of the herd is a formula for disaster at those extremes. Contrarianism at the extremes is how you avert major losses and ultimately achieve superior long-term results.
Go against the tide when it's extreme. Fifth,
combating psychological influences within yourself and being aware of them in others. Recognizing the pull of greed, fear, envy, the pressure to conform, and the tricks your own ego plays on you. You have to consciously choose reason over emotion time and time again. It's a constant battle.
Reason over emotion. Okay, sixth,
patience and fortitude. Because, as Marx reminds us, underpriced is far from synonymous with going up soon. An asset can stay cheap for a long time. You need the patience and fortitude to tolerate looking wrong, sometimes for extended periods. As he famously says, being too far ahead of your time is indistinguishable from being wrong in the short term.
Patience is key. Seventh,
a deeper understanding of risk. Moving beyond the simple academic definition of volatility to the real-world risk of permanent loss. Knowing that riskier investments entail a wider range of possible outcomes and a higher probability of loss, not just a guaranteed higher return. Understand the potential downside.
Understand what can go wrong. Eighth,
defensive investing and margin of safety. Prioritizing survival in adverse conditions is paramount. Marx's brilliant adage sums it up. Never forget the 6-foot-tall man who drowned crossing the stream that was 5 feet deep on average. Averages hide extremes. Margin for error helps you come through intact when things don't go well. These defensive qualities are like hidden assets, often only truly evident and appreciated in the bad years.
I'll prepare for the unexpected depth. And finally,
ninth, knowing what you don't know. Rejecting the seductive illusion of macro forecasting ability. Focusing your analytical efforts on the knowable at the micro level, companies, industries, securities, and always rejecting those too good to be true promises of high returns with no risk, maintain skepticism.
Wow, that's quite a list. It really paints a picture of a demanding but ultimately rewarding approach.
And this confluence of principles, practiced consistently, leads to what Marx calls the true mark of a superior investor, asymmetry in their performance over time. He asks the key questions. Does an investor have more winners than losers? Are the gains on the winners bigger than the losses on the losers? Are the good years more beneficial than the bad years or painful? And crucially, are the long-term results better than the investor's chosen style alone would suggest? This asymmetry, this positive skew in outcomes, that is the ultimate expression of real skill, distinguishing true investment mastery from mere luck over the long run.
A powerful call to arms for any serious investor. As we close out this deep dive, I'm personally left thinking about how incredibly challenging it truly is to fight those ingrained psychological urges we all have, especially that fear of looking wrong or missing out. What's maybe one key takeaway, if you had to pick just one, that you really hope listeners internalize from Marx's wisdom today?
Just one. That's tough. But I think for me, it has to be his relentless emphasis on price. It's just so easy to fall in love with a great company or a compelling story. But Marx hammers home again and again that no matter how great the asset seems, a bad price can ruin the investment outcome. It's that disciplined focus on buying well, on the relationship between price and value that truly sticks with me, because that's fundamentally where you build your margin of safety. Everything else flows from that.
That makes perfect sense. Price is paramount. So as you, our listener, reflect on what we've discussed today, consider what elements of Howard Marks' philosophy resonate most strongly with you. And maybe more importantly, how might you begin to apply this uncommon sense, as he calls it, to your own investment approach, inviting more curiosity and critical thinking into your financial decisions? Keep exploring, keep questioning, and thanks for joining us on the Deep Dive.